What are options? Who can tell me what options are? Besides Susanna, who has them. I think you were first, but I missed it. Yeah.
The rights in the future to buy shares to get ownership of the company.
What else? I'm missing one thing.
At a predetermined price or at a specific price?
Set.
At a set price?
Set when?
At the time that you were to draw those options.
At the time what? So
At the time when you have to draw those options.
right. So set today.
Mm-hmm.
In other words, you're right. You're right. So what is an option? Let's see. Well, it's not one of work even. Okay, now it's working. There we go. So this is what we're going to talk about, right? We'll forget about that. Who cares? Okay. So options are very much like this. We know that if you go to the stock market, you can buy shares in a company, right? And those shares are liquid. What does it mean, liquid? You can buy and sell them. It's not cash, right? It's not liquid in the sense that it's cash. Options are very much like this, right? I just have to have a broker, or I can go online. I can buy and sell shares readily. Now, there's something else, a different kind of equity called an option. An option is, well, we'll see the definition in a minute, but an option is an opportunity to buy shares in the future at a fixed price today, at a price that's fixed today. So let's say I start a company, right? And I'm the founder of the company, and I have a partner, and I hire some people. So I want to give them an incentive. And the incentive besides salary, right? Or maybe even instead of salary, right? I don't remember properly, right? But we'll talk about it. Anyway, I want to give them an incentive. So I say, listen, I'm going to give you options in my company. An option means that this is a guarantee or a legal obligation that allows you to buy shares in the company at a price that's fixed today. So let's take an example. So usually, in a very, very early stage company, we just started it, and I'm hiring people, and I give them options. The price that I fix today is usually going to be under $1, right? 10 cents, 25 cents, $1, right? Whatever we decide it will be. So what does that mean? That means that, let's say, I have 1,000 shares, 1,000 options, rather. Okay? This gives me the right to buy 1,000 shares in the future. At what price? So the option is going to be set at 10 cents. Okay? Now, when I'm able to buy the shares, we don't know yet when we're able to buy the shares. We're going to get to that. But when I'm able to buy the shares, let's say the price of the share is $10 instead of 10 cents. What happens?
Magic.
What happens?
You will still be given the 1,000 shares at 10 cents.
So I pay 1,000 shares. I buy 1,000 shares, but I pay 10 cents. How much money did I make if I sell the shares at that point?
10,000. 90 cents per share.
90 cents?
Per share.
90 cents.
$9 and
Sorry.
How much?
$9 per share.
So I make the difference between what I paid for the shares and what I sell the shares at, which is the current share price. Right? The current share price is $10. What if this went up to $100?
Whoa.
So then this would be 99, right? So what we see is very simply that what the incentive is. The incentive is that I'm giving you the opportunity to make money in the future. How? Because I'm going to give you something that has a fixed price today against something that has a variable price in the future. With the expectation of what?
Growth. Growth.
Growth. I would say a little different again.
Okay.
I would say with the expectation that the value will increase. Because that's what we want in a company. What we want to see in a company is the price which is the value of the company growing. Everything we do from the time we start a company until we exit it, we want to increase the value of the company up and up and up and up and up. The more we increase the value of the company, the more this becomes worth. Right? Yes.
I have heard, but I would like to ask you from experience, is it also common that it says, for example, you can buy for X% below market price, or is it always like a predetermined dollar price?
The option, you mean?
The option, yeah.
Options always have what's called an exercise price set when the option was issued. So every time you issue, we'll see that every time we raise a round, we have a new option pool. And every time there's a new option pool, there's a new exercise price. And the exercise price is based on the share price at the time the option pool is created. Okay? And it's going to be a fraction of that price. Right? What fraction? Who knows? Okay?
But employees having the right to buy stocks of the company they work for at a discount, let's say 10% cheaper, is an offer a company makes, which is not an option. It's like a separate benefit.
I understand. I hear what you're saying, but I don't understand what you're saying. I don't know what it means to give somebody a discount on the price of a share.
I have heard that, or some friends of mine, maybe I misunderstood, that they received, when they signed for a startup, it said in their contract, not that they have 1,000 options, but rather they have the opportunity in the next 5 years to buy shares, if they go public, of that company
That may be.
for 10%
I
below
don't
the
know.
market price.
I'm not dealing with it.
Okay,
I'm dealing with options.
that's not an option.
Okay? Yes.
But I had something like that, but you have like a fixed quantity, like they don't
Okay.
set a price for you at the beginning, they set
I don't want to deal with it. I want to deal with options. I want to understand options. We're going to understand a few different kinds of shares as well. I want to understand options. Okay? So this becomes very clear why this is an incentive, right? Is it not clear to anybody? Does anybody not understand why it's an incentive? Yeah.
I just have a question.
You know,
Does it ever happen where options are offered at a price higher than the current share price?
same thing.
Or does it ever happen where options are offered at a price higher than the current share price when they're offered?
We'll get to it, but the answer is no. Why would anybody do that?
Well, maybe.
It's not an incentive then.
Well, maybe.
But that's it. On the contrary, we'll get to it. We'll get to it. There's a special case like that. But it's bad. Let's just say it's bad. You don't want to be there, right? And when it happens, you have to correct it. Okay, but we'll get to it later. Okay, so that's what an option is. Now let's look at with people, right? So we start a company. I'm the founder, and I have a partner, right? Marat's my partner. He's a nice guy. I like him. We work together well. Okay, great. So now the founders, we're going to split the equity somehow. We're going to talk about how we split equity later, because I think most people get it wrong. But we'll talk about it. We're not going to deal with it. But we also have the initial people that we bring in, right? So, okay, we're good, but we need more people than that. So we hire an engineer, we hire this, we hire that. That's the initial team. So the initial team is like 5, 6 people. Great. Later, we're going to hire more employees. That's how we're going to fill out the company. And then after that, we're going to get investors. Each one of these people are going to get different kinds of stock. Right? So the founders will probably get founder stock. Founder stock is regular equity. Right? Nothing special about it, really. That's what you have. Right? Now, there could be terms to it. We're not going to deal with that. I don't want to get into that. Restricted stock, on the other hand, the first people will come. They're probably going to get something called restricted stock. So what's restricted stock? Does anybody know?
I guess it's something that you cannot easily sell your stocks. You can offer to someone in this founding team at first.
It matures over time. So there is a specific time period which is allocated and it matures over time.
Excellent. So both of you are right? You filled in what Dennis said. So restricted stock means there's a certain restriction on it. What's the restriction? You can't sell it. Till when? Till either some time in the future or some event. What would be a typical event that would allow you to sell restricted stock? Anybody know?
Angel investors or Series A funding. No?
No.
IPO?
IPO. An exit. Right? And maybe even 6 months after the exit. Right? It may also be that. At the exit, you might not be able to do it yet. But exit plus 6 months or something like that. But the exit could be. Right? So the restricted stock, on the one hand, it's pretty cool. The difference between restricted stock and options, no exercise cost. In other words, I don't have to pay anything. Once I get the stock, the only problem I have is I can't sell it until something happens. But when I get it, I don't have to pay it like an option. Here, I have to actually buy the shares. Okay, I'm paying a discounted rate, but I still have to buy it. Restricted stock, I don't have to buy it. I just have it. On the other hand, there's more taxation. Right? In other words, every time this vests, we're going to talk about vesting. You know what vesting means?
Vest is basically, I think it takes X time until you're eligible to redeem those shares.
Yes.
That's the vesting period.
So vesting means, I have options. What can I do with my options today? Can I sell them?
No.
Are they liquid?
No.
Is it anything?
As of now, no.
It's zero. Right? What I've been given is a right. I've been given a right to buy shares in the future at a fixed price today. Do I have shares today?
No.
No, not at all. Right? Restricted, so here, I have to wait until I can own the shares. Right? I can convert the shares. Restricted stock also vests. But the difference is, here, every time it vests, I have to pay tax. Why do I have to pay tax? Because I've just been given a gift. Since I don't have to pay for it, right? Here, I have to pay for it. Restricted stock, I don't have to pay for it. And since I don't have to pay for it, every time I vest a portion of it,
What's the vest?
a period of time, we'll talk about it. It's a period of time at which the right becomes yours. Okay? We'll talk about it, don't worry. But it's basically time-based. Okay? So vesting is just time till they convert to you. Yes?
I thought that vesting was a period of time that founder is committed not to get out from the startup.
Sorry.
Okay, I thought, and actually I read that the vesting is this obligation for a startup founder to get his shares only if he stays at the company for at least 4 or 5 years.
Okay, well, hold that thought. We're going to get to vesting. You're right and you're wrong. Okay? Part of it is right for time, but you don't have to stay a full 4 or 5 years. We'll see. Yeah.
That is called RVPA, reserved stock partners agreement, something like that.
So again, it's like,
It's there is a specific scenario. It does not happen always that the founders have to be.
so we're gonna get to founders. Let's leave founders alone for now. Founders are a different case. And we want to get to that separate. Yes.
A question on the restricted shares. You mentioned that they can either sell it during the exit or 6 months after an exit has been made.
So-
Is there a specific reason why
Yeah,
it's 6
it's,
months?
whatever the restriction is, but the restriction is usually either time-based or event-based. You can say you have to be here for 5 years and then you can leave, right? Or we have to get to an exit and then you can sell. So it's either time or event. But in the meantime, I'm vesting. I don't have it all yet. In this case, it's the same as options. I may have the options, but I don't have the right to use them yet. I earn that right over time. That's vesting. Here, I have to pay tax whenever I vest because I got a gift, since I don't have to pay for it. Here, I have to pay for it. So it's not a gift. Even if it vests, it's not mine. I'm not mine until I do what? Until I exercise. Okay? Yes.
So the founding team is able to use the vesting restricted stocks, for example, in 5 years. They can get a kind of shares in
You're talking about the founders again?
restricted stock. I mean,
Yeah.
the founding team. Yeah.
Founder team, yeah.
Does it mean that if during this 5 years period someone decides to leave the company, he doesn't get?
It depends. We'll see.
Okay.
It could be that if you didn't get through the time, you could walk away with nothing. Okay? Why do you do that? Why do I make people stay?
Because I want to in order to they should work with my company for a long period of time. They should contribute in the company a lot.
Because they're valuable to the company. I need that. Right? I don't want them to leave. I want to keep them. Okay, let's keep going. We're getting stuck. Employees, finally, are the ones who are going to get stock options. Okay, the regular employees. Now, which employees? Any employees, all employees. That's up to you. We'll see who's going to get it. And then the last one are going to be the investors. Now, the investors are going to get a different share of stock. Sorry, a different class of shares. And that's going to be preferred stock. Preferred stock is, we're going to learn all about this in term sheets. But preferred shares have preferences. It's in the thing. I don't know why I can
Yes,
take
yes.
pictures.
I just
All
want
of
to
them.
share quickly with someone.
Anyway, all of these shares are a little bit different. So let's see what the differences are between. All right. Now, preferred shares are what investors get. And this is going to be the bulk of what we talk about when we get to term sheets. What are the rights of the investors through the preferred shares that they get? Okay? So, you can see this is basically what I said. Common stock is what the founders get. Common stock means they have voting rights, right? Founder stock is similar to that, and the other things we already spoke about. Okay?
Is there a difference between like founder stock and common stock? Like
Sometimes common stock means that's like a share that you buy of IBM in the stock market. There's no difference. It's a share of the company. It has voting rights, has ownership rights. But founder stock often will have other like limitations to it. Okay? So it might vest over time. As opposed to I start the company. I started a company with 10,000 shares. So 1 million shares. All right? Let's make it a bigger number. And I have 50% of the company. So 50% of the shares are mine. I own 50% of the shares. I own 50% of the common stock. I don't need founder stock. I already own my stock. If I want to get something else, then maybe I'll take it. Or I'm the founder, and you're the guy I brought in. So I'm going to take my common stock, but I'm going to give you founder stock. You're not going to get the same class of shares as I am. So it's all legal games. Okay? Let's keep going. So a stock option, we said, is a benefit. It's the right to buy a share in the future at a price that was fixed today, with the expectation that the price of the share in the future will be much higher than the price that was fixed today. And it doesn't matter when the options are issued. As I said, every time we make an investment, every time we take an investment, now we're looking at it from the entrepreneur side, right? We're not the investors, we're the entrepreneurs. So every time we take an investment from a new investor, every time we do a new round of investment, like we talked about last week, remember pre-seed, seed, A, B, C, D, etc. There's going to be a new option pool. Why is there going to be a new option pool every time we take an investment? I'm going to take a drink. I'll give you time. Yeah.
To maintain the dilution,
What?
to control the dilution,
Say it again.
to control the dilution.
Okay. So the reason, yeah.
Like to keep this like figures of 10% of founding team, 10% of employee on the same level of
No,
shares.
it's going to be different every time.
Ah,
The founding team is the founding team. So if I take it in an A round a year later, whoever I hire then is not in the founding team, they're
Yeah.
employees. Right?
But the pool is like stocks and the pool of stock options should increase also.
Wait. Yes,
I have a question regarding like how we do it,
how you do what?
the option pool. Do you issue,
We'll get.
okay.
Wait, we'll get there. It's all good. Okay, so this is the option. This is what an option is. Now, creating an option pool. I think I have to do that, right? Okay, so what happens is, we're going to see it a little bit better here. So what's going to happen is we issue a certain number of shares. So whatever the number is, it doesn't really matter. I don't care about numbers. I don't care about that number, right? But the way it'll get divided is, we're going to say 20% of the option pool. By the way, I didn't answer the question. Why do we have an option pool every time we take an investment? And the answer is, why do we take an investment? You know, this is like me being Jewish, right? We answer a question with a question. So why do we take an investment? What's the objective of the rounds of investment?
Raise capital.
So then,
To raise capital.
good. What are we raising capital for?
Reach milestones in the startup.
Okay, good. How do we do that?
By investing them. To hire new people.
To add new people. Whenever we take an investment, generally speaking, we're adding people to the company. And if we're adding people to the company, we need options to give them. And since we're taking in a new investment and we're hiring new people, the assumption is, not always accurate, but the assumption is that we've used up the previous option pool. With who? The people who we hired last time. So every time we take a new investment, the main objective is to grow the company. Growing the company often requires us to hire new people. If we have to hire new people, we want to give them an incentive too. So we create a new option pool every time. So to create the option pool, all we do is we designate a part of the equity to be options. Now, last week, we spoke a little bit about cap tables. I asked you to look at how you create a cap table. I asked you to look at the book. And we saw, what did you see in the book? What was the thing? How do you list options in a cap table?
No, because it's separate. This is the part of equity.
What?
It's the part of equity.
Yeah, but how do we list it? What's the column called? It says percentage. What's that column called? Fully diluted shares. And I said last week, if you look, where are you looking? Fully diluted stock. Okay? Fully diluted stock means like this. Since when I give you the options, they're meaningless. They don't count as equity. Because why? I don't own them yet. I have a right to buy a share in the future. I don't have a share today. I have a right to buy it in the future. But I'm diluting the equity pool. I'm taking 20% of the equity and I'm assigning it to options, which means that at some point in the future, if everybody stays and everybody vests and everybody exercises their options, what's going to happen to me? 20% of this is going to disappear to them. Which means that today, when I issue the options, even though nobody can actually exercise their options today and convert it to equity, I have to recognize it as fully diluted. Fully diluted shares means it's as if they exercised all the options today. And this way, the cap table is accurate. Because what happens, Sophia? What happens, Sophia? What happens, Sophia, if I don't put it in, if I don't recognize it today?
I will wait by.
No. What happens in the cap table?
Dilution.
It looks like we have more.
It looks like we have more equity. In other words, instead of having 80%, it looks like we have 100%. That's why you have to recognize it as fully diluted. Fully diluted means as if the options were all exercised. And instead of it being just a right, it was actually shares. Okay? So far, so good? Any questions about this? This is important. You were first.
What happens, for example, I set the 20% option pool and I hire someone and I'm going to give them 10% of that 20%. And then I fire that person. What happens with that?
We'll get to it. Yes. Wait, you mean you hire them and fire them right away, or you hire them and fire them in 2 years?
You fire me before the vesting period, so the 10%.
Okay, so wait, we'll get to that. Just hold on that. Yeah.
How we can evaluate the price per share for any like options and future shares when the company do not get any investments and do not officially evaluate it? I mean, like growing from their, like organically growing from their money without any investors at all. How to set up the prices?
Hold on, we'll get there.
Okay.
It's all in here, yeah. I want to know if you have any questions about what I've said so far. Not what I haven't said.
No.
Okay, I think that.
You're right, okay. Now, one other question, and this we're going to see in turn, oh, yes.
One last question. Every time we create an option pool, the 20% is cost money, right? Like we do the calculation of the.
We'll get to it. Good question, excellent question. By the way, is the option pool always 20%?
No.
No, well, how much is it?
It depends. It depends.
What?
Whatever you,
Whatever I want?
like the.
I want it to be 3%.
How many people?
What is the determining factor of the size of the option pool?
The fund and pre-money valuation, how much we raise.
The option.
How much the founder wants to incentivize the investor.
What's the determination of the size of the option pool? So we'll get to term sheets. We're going to have two term sheets we're going to see as an example. One is going to have a 20% option pool and one is going to have a 15%. Why is there a difference?
Size of the company? Less
No,
employees?
amount of employees who you want to be.
How many people do you think you're going to hire? Not the size of the company. Like I said, it was like,
Okay, fine.
okay? Okay. So let's keep going. So far, so good? Good. So when you think about hiring people, the question is always going to be, how much should I give them? How many options should I give them? Okay? So this represents 20%. Okay? So one of the ways that you can do it, we're going to look at a couple of different ways, but one of the ways you do it is you divide up the equity into different chunks, different sizes, right? So 1% chunks, 1/4%, 1/8 of a percent, you can divide it up into any size chunk you want, right? Now, why do you do that? Because it makes it easier this way to think about how much I can distribute to who. right? How am I going to divide this all up? If I just say I have 20%, so maybe I'll be like Susanna and say, somebody's coming along, I want to give them 10%. Not a good idea, by the way, generally speaking, okay? So I have to figure out how I'm going to do it. It really depends. We'll see when it might work, right? So here, for example, right, I can take that initial founding management team and I can say, you know what, here are my guys, and then based on what they're doing, since they're early, they're taking more risk by joining the company early. I'm going to compensate them more with equity. Sorry, I'm going to compensate them with more equity, with more options. So here I'm going to divide that 10% into a couple of different chunks based on what people are doing and the value it has to me in the company. That's one way of doing it. Let's keep going. But I can have an experience multiplier as well. I can say based on their experience, they're going to get more. So that means somebody who would be a C-level officer, chief operating officer, chief marketing officer, chief technology officer, chief whatever officer, I'm going to give them more because they deserve more, they earn more. Or I can look at a secretary who I also want to compensate, right? Somebody, an office worker who doesn't really contribute that much, although some people say the secretaries are the ones who are the most valuable. And I can tell from my own experience, it's really true, right? So I always compensate my secretary very well. In any case, the bottom line is I can look at a multiplier based on their position. So if they're a C-level, a VP, a manager, a director, a line person, or something like that, we might have a multiplier. Good. Whatever you want, that's up to you. This is not hard and fast. These are generalities of how you go about it. Right? But the first thing is, how do you actually divide it? Now we're going to look into other things, right? So why is it that we give options? The economic reason is very simple. I want to incentivize you. If I give you a reason, what do I want to do? I want to create value in the company. My objective is to get rich, right? I want to make a shitload of money. So how can I do that? I need your help. So what I want to do is get you on the same page as me. I want our interests to be aligned. So by giving you an ability to make money yourself, right, I'm aligning my interests, your interest with mine. The better the company does, the better you do as well. Not just me. We all in it for the same thing. So number one, we want to make everybody's interests aligned. We want to use it to raise money for the employees. This is a form of compensation. People make a big mistake, by the way, outside of this, right, of options. People usually make a big mistake when they're looking for work. What's the mistake? They look at salary. And I say, okay, this job pays $100,000. This one pays $90,000. Which one should I take? Well, most people would say $100,000. That's a mistake, right? If that's all you're looking at, it's a mistake. Don't look at salary alone. Look at compensation. Compensation is everything that you get from the company. So salary, options, bonuses, health benefits, travel benefits, clothing benefits, expenses, whatever it is. Look at the package. And then when you understand the entire package, then you might say, you know what, this is a little bit of a higher salary, but I have much less benefits. And the benefits are going to cost me. And it's, guess what? It's going to cost me more than the difference between the $10,000 extra I'm getting. So even though I take the 90, maybe, I'm actually earning more money. So don't just look at salary. Look at the entire package of compensation that you're getting, because everything that you get has a value, right? Anyway, so here, what I'm doing is, one thing I'm doing is I'm able to raise money from employees by doing this. How do I raise money from employees by doing an option?
You pay less.
You might pay less, right? You know, I'm going to give you a package. I'm not going to give you a salary. I'm going to give you a salary plus equity. And the equity has value. So by being able maybe to save a little money, I'm actually raising money for you. At what? At a pretty low cost right now. So you have to be careful, right? And my son, for example, doesn't work for equity. He works for money. Because I don't want to get options. There was a period in the Israeli tech industry where options were worth a lot of money. And then there was a period where options were worth nothing. And my son went to work in that period, right, in the transition. And he said, that's it, I'm not working for options anymore. I want money. I want salary. Bonuses and salary, that's all I'm taking. And now he makes a lot of money getting bonuses and salary. But that's a different story. In any case, so one reason is I can raise money from the employees. Another reason is it's aligning your interests. You have the same interests as me. And another reason is I can attract talent, right? By offering money, by offering equity, I can maybe attract talent from other companies that might not be attractive. So there are different economic reasons why we want to give options, okay? Now, what about from my perspective, the employee's perspective, right? So sometimes I remember after the market crashed in Silicon Valley, nobody was hiring. So they started hiring options only. In other words, they weren't offering salaries because nobody had money to pay, right? The market crashed, investors weren't investing. Whatever money they had, they were saving, ran out. They needed to grow the companies. They needed to hire people. They hired on equity only. But it wasn't equity, it was options. And they gave you an attractive option package, like more than you would usually get, but less than, and at a really attractive price. But it didn't make up for the fact that you didn't have a salary. You had to be able to afford not taking a salary and working just for the equity, which meant what? I was paying, yeah.
I was going to say something about
Yeah.
talent recruitment,
About what?
recruiting talent.
What about it?
That sometimes I think if you're offered a lot of equity, but not a lot of salary, you might lose really good people who really need salaries.
Good. It's a balancing act, right? It's really a balancing act. But the bottom line was, if you were getting equity only, you were paying your expenses. So usually your salary covers your living expenses, right? And the equity should be a bonus at the end. Here, it was the opposite. Like you were paying your living expenses and hoping that you would make money at the end. It was a big gamble, and a lot of them failed because the market just wasn't there for it, right? So the thing about options, and this is why my son doesn't want them, is because it's a high risk game. Anybody who's gotten options, right, in history, has options that became totally worthless. Like we said, we use them for toilet paper because that's all it was worth, right? So you have to always evaluate the company you're going to work for. And we're going to talk about this in the soft skills coming out, right, about job. So how do you decide to work for a company, right? And what do you do? So we spoke about this once a few weeks ago. What is it that motivates people, right? It's not just salary, challenge, empowerment, responsibility, appreciation, et cetera, right? So when somebody offers you a job, like at a startup, the reality is that 80 to 90% of startups fail within 5 years, right? 30% fail, 30 to 40% fail in year one. I'm offering you a job in my startup. What do you think? Is it a good idea? Will the company be around?
It depends.
Right? Is it worth the risk? Et cetera, et cetera. So here, if you think the company has value and can be successful, having a piece of the upside through options could be a really good idea. But if you don't think the company is worth it, why would you trade salary for options, for equity? If you don't think the company is going to be around.
It's actually beneficial.
And if you don't think the company is going to be around, why would you work there to begin with? Unless you're really desperate for a salary. Right? Which happens. Anyway, so here, there's two sides to every coin. Right? You have to understand both sides. Let's keep going. So again, it's about placing the right bet, which we just talked about. Also, like somebody asked the question, what happens if Oliver just walked out. So what happens if the exercise price is above the share price? Well, nobody would ever accept an option like that. It always has to be below, because otherwise it's not an incentive, right? Which we'll see in a minute or two, right? But what if the share price? So when I joined an early stage company, my option price is usually under $1. That's pretty cool, right? Because if I hang out for a couple of years, right, maybe I can get the price up to $10, $20, $50, $100, and then I have something that I can actually earn. But what if I join a company that's at $46 a share? It's not an early stage company at all. It's a mid-tier growth company. And the share price is $46, and I'm getting an option for $40. Different calculation. Now you have to start to think, okay, what's the potential price that this company can reach? How are you going to do that? How are you going to evaluate that? We did it once. How are you going to do it?
The market size,
Anybody remember the talk we had on valuation?
Yeah, there is
How did it start?
a lot of different.
We started talking about public traded companies, and we started talking about analysts. And analysts give you price predictions, right? So you can take a look at analyst reports, and you can see what do they predict for the price of this company. The example that we gave was Apple Computer when the price was $229, and the analysts all said the price is going to go up to either somewhere between $250 and $340 or something like that. So if I'm getting a share at $220 or $200, it might be worth it, right? Because there's at least $100 of growth in there. Maybe not, right? So when you join a company later and the price isn't $1, but it's a price related to the actual share of the company, so it's a different evaluation, it's a different consideration. Okay? So now we get to vesting. Everybody pay attention. This is vesting. Vesting means that you earn the shares over time. Susanna, this is going to be the answer to your question as well. So usually, a vesting schedule for a typical option plan in a tech company, a tech startup, is 4 years. Okay? 4 years. Now, some of them are 3, some of them are 5. Average is 4. Typical is 4. The way it works is like this. So here's when I get hired. The plan, the vesting schedule, works like this. Typically, the first vest is after 1 year. Good? I work, and then after a year, I vest the first time. This is called a cliff vest, like a mountain, like a cliff, right? I don't know. Anyway, it's a cliff vest. So why is it for a year?
First of all, so that the employer can make sure that
Right.
First of all, so that the employer can make sure that the employee is a fit for the company.
So I want to make sure that the person I'm hiring is a good fit. That what? Why did I hire him to begin with? I want him to help create value in the company. What if it's not a good fit? Right? I come, I start working, and you know what? I don't like you. I don't like the company. I'm not happy. I want to leave. I did that. I first moved to Israel in 1979, and I got a job at the Israeli post office. as an economic analyst. I started working on a Sunday. I quit on Thursday. I literally quit on Thursday. I was like going out of my mind. It was so bad. Anyway, so what if that happened? Susanna, you had asked the question. What if you hire somebody and you don't like them and you fire them? So as long as it's before 12 months, what does he get in equity? Zero. Why? Because he hasn't invested in it yet. By the way, this is a common practice in Israeli companies. El Al, for example, the national carrier, all of the stewardesses or flight attendants, I think we call them today, right? They get hired on 11-month contracts. Why? Because if you work for 12 months in Israel, you're entitled to severance pay. So instead of giving them severance pay, they hire them and then fire them after 11 months. And then they're not obligated to pay them anything. There's no severance. So it's the same idea. If somebody comes and works and it doesn't work out, they leave, that's it, done. I don't owe them anything. They don't vest anything. Yes.
And they can use the remaining for another employee.
They have no recourse at all. Okay? Because it's in the plan, obviously. By the way, an option plan is two legal agreements. One is the option plan itself, which describes all of the terms of the plan, and the other is your grant, what you were given. Two separate legal agreements for every option agreement, for every option plan that the employee has to sign. Okay? One is the overall plan. I accept the terms of the overall plan. And in that is the one where it said that if you leave before 12 months, you're not going to get anything because you didn't invest anything. And the other one is agreeing to accept the amount of options that you got and the terms for that. Good. Once you get past 12 months, now there's option. Now there could be alternatives. The most employee-friendly option vesting program is monthly vesting. But that's not the way it usually works. Usually it works quarterly. So 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. So if we take a simple example, we have 1,000 shares, right? At the end of the year, we get 250. Sorry, we have 1,000 options. At the end of the year, we vest 250. And then every quarter after that, we get another 60, whatever, 4 or 5, whatever it is, right? Yeah.
Question, once they vested, let's say even after 4 years, do they have expiries or do I have the decision of whether I want to exercise it?
No, as long as you're with the company, you keep vesting. And when you get to the end, you vested 100%.
And then I leave the company and I keep the
Well, next step. Okay? Now, Daniel, right?
Yes.
So Daniel's question is, what happens if I leave somewhere in here? I've already passed my cliff. So now I have options, right? But now, okay, I'm somewhere in here and I want to leave. So let's make it simple. I leave after exactly 2 years. I vested 50% of my options. And now I say to the company, you know what? I got another job. Whatever it is, I'm leaving. What happens to my options now?
Just, you would get
Sure.
after the 12 months, you would get the vested 25% plus whatever percentage it is a month. And I just wanted to say,
Sure, it's 50%. We're exactly 24 months.
so you would get the 50% of your option.
And that's it. They're mine.
No, you need to buy them.
I need to buy them.
Yeah.
When?
At that point.
At that point.
Yes.
Okay. Anybody have any different opinion? It's almost right.
Just another thing. Wouldn't it be 1 out of 36?
Say it again?
Wouldn't it be 1/36?
No. Each month is 1 over 48.
But
You're only getting 1
I
month
see, okay.
out of 48 months. Right? So each month you're only getting 1/48 because you already got 25%.
Okay.
So is Oliver right or wrong? He's wrong. But what is he wrong about? What is he wrong about? He was right about a lot. What was he wrong about?
He can't buy options because
You can't?
No.
You're wrong. You can't. But what was Oliver wrong about?
Well,
The timing.
time.
The
Timing. Oh, very good. So what is the right timing?
The date is definite in option already.
So here's the
4
deal.
years, 4 years.
In the typical option plan, I say typical. Why do I say typical? Because not every option plan is typical. Okay? In the typical option plan, if I leave anywhere before here, then let's say here, I vested 50% of my options. Have I exercised my options yet?
No.
No. Why not? When do you exercise options?
6 months after exit,
Say it again?
6 months after exit.
There has to be trigger.
No, not necessarily. When do you exercise your options typically?
You said that it's either a time or a trigger.
No, that was restricted stock, not options. Okay? When do you typically exercise your options?
Your exit.
When you can buy the shares. Why should I exercise my options before I can buy my shares? Now, when can I usually buy my shares? When there's an exit. In other words, why should I do it before that? I'm not getting any benefit. I own the options. I can own the option for 10 years. Nobody's going to force me to buy them, to exercise them. And if there's no exit, there's no economic reason for me to do it. But there is one. If I leave somewhere in the middle, and typically what happens is I have 3 months to decide whether I want to exercise my options or not. Why? I'm leaving. I'm not part of the company. So on the one hand, I worked for 2 years. I earned the right to be able to exercise 50% of my options. On the other hand, I'm not staying in the company, so I have no right to continue to vest. Maybe I shouldn't have the right to exercise my options. Maybe, just like restricted stock, I should have to give it back. So there's a compromise. And the compromise is, if I leave somewhere in here, I have, again, typically 3 months to decide whether I want to exercise my options or not. If I decide I want to exercise my options, so let's say I had 500 shares and they cost 10 cents each. Sorry, I had 500 options and I could buy 500 shares at 10 cents each. I give the company a check for $50 and now I own 500 shares of the company. Can I do anything with the shares? No, generally not. It's a privately held company. There's no exchange. That's changed recently, but let's assume there's no exchange. So I'm holding on to the shares, hoping one day what will happen? There'll be an exit, and then it'll be worth something. Okay? Now, I said the typical plan. Some plans said, if you leave here, you leave empty-handed. And if you wait more than 3 months, then you leave empty-handed. You have a short window in order to decide. Why do I give them a window to decide? And why might I not? I give them a window to decide because they worked for 2 years. They earned it. But what's the problem?
Need also visibility to see which shares are coming back to the pool for next rounds, no?
That's if they decide not to. But what's the problem with them taking shares in the company?
Well, and if they leave, you're gonna need to rehire somebody else, and that person's gonna get shares. And, like,
Yeah, that's fine. That's natural. The problem is they're a shareholder in my company.
Like passive
I have to worry about that. But now they're a shareholder. They're not adding value anymore, but they're a shareholder in the company. That's the problem with founders, by the way, Susanna, and 10%. So we're going to talk about that when we get to founders. So I make a deal with somebody. You're going to be co-founders. And then I give you 20% of the shares of the company. And after a month, you say, you know what? You're a shithead. I don't want to work with you. I'm leaving. Guess what? He's taking 20% of the company with him. So we do it. We don't give shares. We give stock. Sorry, we give stock options. Something that has to vest. Something that has to demonstrate that they're worth keeping. And if they're worth keeping, then we're happy to share something with them. And that's the whole basis of vesting that allows us to vet, not vest, vet, right? The people who work for us. By having them have to go through a cliff, right? Then we get to see whether they're worth keeping or not, whether they're going to stay or not. And if they stay and if they create value and they leave afterwards, okay, so be it. Nobody's an indentured slave to a company. Okay? So they take what they earn, but they can't hold the options forever. Now you have to make a decision. Do you want to buy them? Do you want to exercise them or not? You want to exercise them? Pay for them. And then you can walk away with the shares. You don't want to exercise them? That's your right too. They go back into the option pool. Right? Now, let's say you were the person who's leaving somewhere in here. And now you have to decide, exercise my option, buy shares, or not. What would you think?
Buy. I will buy.
You would say, I'm buying.
Yeah.
100%.
Okay, anybody else?
I would do the same thing.
You would do the same thing. Anybody else? Any dissented opinion? A counter opinion?
I will make decision depend on how I estimate company.
Can't wait. You have 90 days to decide.
Yes, in these 90 days, I have some estimation of the.
So what are you going to look for? What are you going to use to decide?
The future.
If I believe in this company, I already spent this.
Do you believe in the company? In other words, if you think, why are you leaving? So some people leave because they're bored or they have other opportunities or they have better job offers or whatever it is. Some people leave because they're going to get off a sinking ship before it sinks. The question is, why are you leaving? What's your opinion of the company? Do you think the company can do well and maybe create value for yourself through an exit? Or it's a sinking ship, you're going to get out of here while I can, and any money that I would put in just doesn't make any sense. Yes?
Wouldn't you argue though that it's worth the gamble even if you don't believe it?
No, I wouldn't argue it because every person is different and every person has a different opinion about how they want to gamble their money.
But like if you can afford to buy the options and the company you're working.
You know, if you're looking at a company that's going bankrupt and you're getting out, and why would you put money in before that?
Well, if they're going bankrupt, I guess it's a different.
Look, like I said, everybody decides for themselves. I'm not going to tell somebody what to do. Yeah.
I have a question. Can I sell my option to somebody
On the market? No.
in the
So you can't sell options.
and even after I
Purchase the share.
after the vesting time was finished.
Sorry. You mean like exercise? The word is exercise. Okay, we'll get there. Okay, so let's keep going. We need to take a break. We'll do it in a minute. Right? So now there is something called accelerated vesting. Accelerated vesting means that, let's say I'm here, and now something happens. Like what? Like an exit. So the company is being sold here. I've earned 50% of my options, or some number here, or whatever it is, or anywhere in here. But, you know, now I really want to be able to sell all of my options. So there's something called accelerated vesting. Accelerated vesting usually takes place when there's some sort of liquidity transaction. And what happens is, means that when there's an exit, then I get to vest all of my options. Now, there are two ways that happens. It's called single trigger and double trigger. What's the difference? The trigger is the event. A single trigger means that if you have it, accelerated vesting on a single trigger, that means whenever there's an exit, you can vest all of your options and sell them. A double trigger needs two things to happen. The first thing is the exit. But the second thing is you have to be fired. So, okay, I have a company, right? And you come along and buy it, right? Which I appreciate. So now I had accelerated vesting. And since I'm a senior executive, I probably have single trigger. So that means as soon as it happens, I'm going to vest all of my options, convert them to shares, and cash out. And I'm most likely, there's a high probability that I'll probably also leave the company. But Evgeny over here, he's the software programmer of the company. And he has something called double trigger. And the reason he has double trigger is because when we sell the company, you who bought it want to keep it. And so if he had single trigger, he would sell his shares and walk away. But since he has double trigger, he can only do that with an exit and being fired. Which for a guy like me in sales or management or something like that, I'm going to get fired anyway because nobody wants to keep me. It's redundant. But a program, because the company that bought me has a CEO, has a head of sales, has all of those things. They don't need me. I'm just redundant. But he's not. And the people in the company that you think are valuable, you actually want to keep. Because the real value of a company is the people who work there. Sometimes it's the leaders. More often than not, it's the guys in the trenches, right? So you're going to require a double trigger for those people. At a certain level, you're not going to accept the double trigger, right? Because I don't need to. My thing is, I want a single trigger. If it happens, I want to get out. That's it. And if you want to keep me, you can renegotiate a new contract with me, right? So that's the difference between single and double. So let's just see where we are. Acceleration, we already talked about this. So I want to do one more thing, and that's the exercise price. And this will answer the question, then we'll take a break. So when the spread, we'll get to it. When the spread is like we described there, my exercise price is down here, and the trading price is up here. I'm going to make money, right? Here I'm making $9. This is called in the money. On the other hand, when the current trading price is below the exercise price, what does it mean? It means in order to buy one share that costs $10, I have to spend $12. Who in his right mind would ever do that? Nobody. You would spend 12 to buy 10? Would anybody do that? I have some things I want to sell you, right? Nobody's going to do this. This is called underwater. So when this happens, by the way, when? In public companies where the price starts to go down, right? We had a company, the price is going up, and all of a sudden, price goes down. Guess what? A lot of people are going to be underwater then, because the share price is now below the exercise price of their options. And that means it doesn't pay. So what does a company do when that happens?
Compensate.
Compensate
the difference.
They lower the price.
Lower the price.
They change the exercise price to make it worth it again, right? Or they'll go out of business, right? Anyway, so this is called being underwater, right? Because you're drowning, right? So with that, we'll stop. Right? We'll take a break now. We'll take a break. Let's do it for 10 minutes today because we have a lot to do and we're going to quiz. All right, so 10 minutes.
Мы сейчас прорабатываем эту историю. Мы не писали.
Okay. So, let's continue.
We're starting.
Okay, let's continue. So we spoke about options. We now understand how they work. So now the question is, which we're not going to go into in depth because you can look at this at home. The question is, how many should I give people? Now, there are a couple of different ways to actually think about how many options people get, right? Depending on what they do. The main thing, the macro is, okay, what's the situation of the company? What stage are we at? The earlier the company, the more risk I'm taking to join it, right? The more risk I'm taking to join it, in theory, the more I should be compensated, at least in the upside, even if it's not in my salary, right? So the earlier that you're in, the better off you are. So anybody ever hear of the PayPal mafia?
Yeah.
Right? Who are the PayPal mafia?
Elon Musk, you
Right. So why do they call the PayPal mafia?
Like everybody started at PayPal and then spread it.
Because they were the guys who were the first people, and they made the most money. They all became billionaires, right? When they sold the company. So, or most of them, they made a lot of money, if not all billionaires. Anyway, so that's what happens when you're very early in a very, very successful company. You make the most. Okay? So, working. It's on. There we go. Okay? So now, there are different ways to assign options. You can do it based on a number of shares. You say, okay, this position gets 1,000, this one gets 500, this one gets 200, this one gets 100, this one gets 50, this one gets 10. One way of doing it. Fair, not fair, you decide. Okay? Another way to do it is percentages. We saw percentages at the beginning, right? So each position gets a certain amount, a certain percentage. The truth is, in not very, very early stage companies, but later stage companies, so then percentages makes a lot more sense. The higher the position, C-level, VP, director, etc., the higher the percentage. That makes sense. And then there's something called the dollar value method. And the dollar value method is meant to replace money. So it could be, I'm giving you options based on the amount of money that you're discounting your salary, or it could be that I'm doing it based on the exit value. All right, so we'll talk about that in a second. All right, so the dollar method is very simple. So we talk about things like this in Silicon Valley. So we say there's a car change, a house change, and a life change. Okay, a car change, house change, life change. Some people say there's a fourth one, so wife change, but we don't talk about that. In any case, right, the more the options are equal to what it would cost, you would get options equal to what it would cost to buy a car, what it would cost to buy a house, or what it would cost to change your life altogether. That's car, house, life, right? So you can see like what's going on here. It's a lot, it could be a lot of money. The higher up you are, the more you're going to get. Okay? Let's keep going. And the market value method is a little bit more involved. So there you're going to have to figure out, here's an example of it. So let's say I want to hire you, and your going salary would be $100,000, $25,000 a year, but I'm going to offer you less than that. So I'm going to offer you here in this example, $75,000. So what are you losing over 2 years? $50,000. So you're losing $50,000 a year, you're losing $100,000 over 2 years. So what I need to do is give you options to make up $100,000 worth of salary that I'm not giving you. Right? So then you can sort of figure out, okay, if this is what I have to give you up, and these are the valuation of the company, So 100 over 10 is 1%. Now the question is, am I giving you this 1% a reasonable amount of options to give you, whatever your job is? Let's say you're just a UX guy, not just, you're a UX guy, you're a software programmer, you're a QA person, right? Is this reasonable or not? So we can look here and say, okay, this is what it would take to do it. Maybe it is, maybe it isn't. So you can calculate it based on the dollars. You can, then you have to look and see if it makes sense based on the actual percentage on the pool. Whatever, it's a way of doing it. These are different, this is just explaining it again. These are all different ways of kind of calculating how much to give. And you can choose whatever you want, whatever best for your company. The disadvantages of options. So why are options not so good for you, for the employee, right? So number one, they're complicated, right? We have all kinds of different rules. We are vesting, we may get, we may not get, may be worth money, may not be worth money. Okay. There are different kinds of options. There's different sort of taxation. Today, the tax authorities want to tax options, right, before you've, before you've exercised them. So today you have to send a letter to the IRS in America that gives you an exemption from it. You pay, so what usually happens is you pay the value of the options that you get, not the cost of the vesting. So if I pay the tax, let's say I get 1,000 options and the strike price is $1, right? So how much are the options worth today?
Again, please.
I got 1,000 options, the strike price is $1.
1,000.
It's worth $1,000, right?
Yes.
So what I do is I pay tax on $1,000. And what happens then is, when they convert to shares, and they're worth $100, and now I've made $99 on each share I sell, it's tax-free. Why?
Sorry, can you repeat that, please?
Everybody always asks that. So if I pay the tax today on the options I receive, right? When I exercise the options, I'm not exercising already. When I exercise the options and I convert to shares, I don't have to pay tax. Yes, Ben?
Are you saying that's actually what happens?
Yes, I paid the tax when I was issued the options.
And then not when, and then.
Yeah, it's like an 89B exception. I forgot the number exactly.
So no capital gains taxes
And I don't
apply
have to pay tax there. So this is like a big, this is a big benefit of options, but you have to be smart enough to do it beforehand. You pay the tax when you get the options, and then you're exempt from the tax, because I already paid the tax.
Yeah.
Okay, so two questions. First, is it your choice to get them taxed that way
Yeah.
rather than waiting and being?
It's your choice. You have to do it.
People need to know that.
It's called an exception.
And then secondly, obviously, it depends on how much more the.
No, that's the point.
It's not yet relevant.
I don't pay tax. Once I pay the tax on it, that's it, I'm done. Okay. Anyway, so the other side is that there's a donation issue, right? And that's what we're going to see when we get the term sheets. How much of the options? And then somebody asked the question, what's the difference between pre-money and post-money? So what's the difference between pre-money and post-money options? Who can tell me? Yeah.
Pre-money option is mean that you calculate the option pool and input it to pre-money evaluation.
Who's paying?
And founders and former investors pay this pool option. But in the case of post-money evaluation, a new investor take part in paying of this option too.
I think you said it right. So I'm going to say it again, just to make sure. So what Marat said is right there. In a pre-money option pool. So let's look at the scenario. We're going to see it when we get to term sheets. I'm taking an investment, right? You're invested in my company. And you say to me, listen, I want to see a 20% option pool in the company before I invest. You go and create a 20% option pool, or a 15%, or a 25%, doesn't matter. don't really care about how big the pool is. But the point is, the investor says, you create the pool before I invest. That's a pre-money option pool. Who diluted?
The previous investor found.
The entrepreneur, the
Yeah.
company. In a post-money option pool, right, and then he invests. And then what happens when he invests?
He diluted also.
We dilute again. In a post-money option pool, he says, we're going to create an option pool after I invest. So now, who's paying for the option pool?
Everybody.
Both sides.
Yeah.
That's the difference, okay? So in effect, what does a pre-money option pool do to the investment that you're getting? As an entrepreneur, what does it do to your investment?
Sorry. Again.
It made it more expensive. Right? In other words, I'm now paying more to get the same money because I have a higher dilution. So homework assignment, take an example and do that. Do a pre-money and a post-money option pool. All right, let's call it 20%, a $5 million pre-money, $4 million pre-money with a 20% option pool, done either as a pre-money or a post-money. See what the difference is afterwards in both cases. Use a cap table. Okay? Okay, let's keep going. So now this is a hypothetical. So if you looked at the cap tables we had, you saw that at the end there were 3 columns for exits, right? And it gave you 3 different values for the exit value, and this way you could see what that was. Here, this is a similar thing. Let's say that you're getting options. So depending on who you are, right, C-level, OE, everybody else. So depending on the percentage that you're getting and the value, the exit value, now you can see what it's worth, right? So what you see is, for example, when I'm up here, right, I got, let's say 2%, it's worth 20 million at $1 billion exit, right? Makes sense. 2% is $1 billion, right? And you can see everything. So if I'm, getting a 0.25%, so I'm doing okay. The bigger the value of the exit, the more I'm getting. So remember, car change, house change, life change, right? So this gives you a sense of, now if you have a cap table, you'd see it in the cap table. Because in the cap table, you'll have exit columns. And you'll have low, medium, and high. And then you'll be able to see what the value of the options are going to be. Because what? The options are represented in the cap table as fully diluted shares, right? You'll always be able to see the value. Okay, great. Now, is anybody interested in founder agreement? Do you want to learn about that?
Yes.
Yes? Okay, founders agreement. So let's say, you can lower your hand now. So let's say you started a company and you want to bring in a founder, a co-founder, right? It's very important to have a founders agreement between you. Why is it important to have a founders agreement?
It sets out the allocation of stock to each of the founders,
What else does it set out?
their responsibilities.
Next. Next.
Yeah, like a commitment and the responsibility.
What else does it set out?
Wasting time.
What?
Wasting period, wasting time.
Vesting time, yes there is. What else?
How many shares would have?
He already said that. What else?
Not only does it give them their allocation of shares, but it also lists their contributions both as work and fund, like fiscal.
So what it sets out is what happens when it falls apart,
Yes.
right? Anybody ever hear of a prenuptial agreement?
Yep.
I have one.
I'm right here. Anyway, a prenuptial agreement is like the most anachronistic thing I can think of. I want to get married to somebody, And what I'm thinking about is what's going to happen when we get divorced. Not the best way in my mind to start a good marriage, right? But when we get to term sheets, we're going to see that term sheets are exactly the same thing, right? We lay out all of the conditions for what would be a successful relationship and also what would be an unsuccessful relationship. Founders' agreements are the same. We want to lay out all the terms of the partnership that we're entering into, including what happens when it all goes the hell in a handbasket. Okay? So it's largely binding, not, may not be completely binding. It depends on the agreement itself, but it also divides all the rights, all the IP, or determines the commitment and stuff like that. Now, there's a huge issue in founders, like negotiating. Yes.
Is it common practice for VCs or angel investors to ask for the founder the thing?
Oh, for sure.
And also for the stock option program?
Absolutely. Every agreement. We're not going to get the due diligence there, but if we did, we would learn, right? Then it would become clear what they get everything.
And they demand.
But it's a question of timing. They don't want to get everything up front. You want to know what it's like? The analogy? So the analogy is like a seduction. I think everybody knows what that word means, right? So seduction means that we give a little bit at a time, but eventually everything is gone. Everything is revealed. It's the same thing with due diligence, right? You start with a little bit, there's a little bit more, until there's a term sheet. Once there's a term sheet, everything becomes revealed. We'll get to that when we talk about term sheets. For now, in a founder's agreement, so these are going to be some of the things. So I was starting to say there's a big issue with founders. So let me ask you a question. By a show of hands. You decide to start a company. You're the founder. And you want to bring in a co-founder. How many of you will divide the equity equally?
No. Absolutely.
How many of you will not divide the equity equally?
With a total.
How many no opinion?
It depends.
I'll find another founder.
Right?
I would find another founder.
Okay. So what happens is most people think that even, equal shares is fair, like 50-50, 25-25, 25-25. This is not true. It's not a good idea. Why isn't it a good idea to do it equally?
Because people are willing to give different things, and it's very hard to decide if it's 50-50.
Joy.
I was gonna say next to that, if we have, let's say I'm the CEO and one guy's the CTO. The CTO shouldn't be making management level decisions and actually making the tech division decisions.
I asked about equity. We're going to divide it equally?
No, of course not.
What?
No, I wouldn't divide it equally.
Why not?
Once again, because if I created a company, I would like to have control over my ideas and let's say I'm the founder of something.
Right.
I think equal division of equity creates conflict because it makes unclear who should make a decision about a particular thing. If it's clear that someone has a majority,
Good.
or if a certain set has a majority,
All right.
you know going into it, you don't get to decide.
The decision how to divide shares depends on many things. For example, which input every founder makes in the company.
So everything everybody said is correct, but you all missed one thing. Everything is great when life is good. When life isn't good, everything is really awful, right? So what I mean by that is, let's say we decide we want to get married and we're going to live 50-50. That's the way it should be, right? Everything is equal between us. What happens when we fight? In a marriage, all right, you fight, you get divorced, right? Eventually, or you make up. But in a business, when you're 50-50, it leads to a stalemate. Nobody can decide, because my vote is the same as yours. And that's terrible. So when everything is good, everybody's getting along, we don't have any problems, we all agree. But as soon as you don't agree, when it's 50-50, you're stuck. Can't move forward. Because there's no way to move forward. I either have to convince you to agree with me, or you have to convince me to agree with you. But if we can't do that, and trust me, it happens a lot, the company is finished because there's no way to move forward. And therefore, in addition to all the other reasons that you gave, which were all good, the main reason you don't want to have 50-50 or even shares, somebody has to be in control. Yes.
Would it be safe to have an odd number of founders?
Robert Ladder.
Would it be safe to have an odd number of founders?
That's not going to solve the problem because you could be 32, 33, 33.
But if two
And
people
then everybody,
agree,
so now you have a coalition,
Yeah.
right? The best thing is to have somebody in control. Right? And usually it's the first person in, because it's his idea, it's his company. Right? Or he's willing to give it up to somebody else. Well, I haven't seen that yet. Anyway, so the agreement covers all of that. All of those things, the good and the bad. What happens when things don't work out? And so the different parts of the agreement are all of these, right? So we'll have roles and responsibilities, confidentiality, blah, blah, blah. Right? You can read this, that's not important. What I want to get to is splitting equity. So if you were going to split equity, you already said the best thing is not to do it equally. What would you do? What would be the considerations that you had in terms of how you want to share equity with somebody else? Yeah, Jay.
Having a controlling share.
So again?
I have controlling part of the company. So let's say if it's two people, I would split it in the way that I have more than 50%. So let's say if I really liked in 46.
Okay, I understand that, but that's not what I'm looking for. It's a good idea. But what would you think about? Yeah.
The roles and the values that each team member bring to the idea that
Very
you're
good.
working on.
So Kelvin, huh? Kelvin says value. Expand the idea. How do you expand that? The right direction. What's the big word that I'm looking for that starts with a C?
Commitment.
Commitment. What kind of commitment do you have to the company? What's your position? Are you doing this as a side thing, or are you all in? Are you working someplace else and doing this at night, or are you quitting your job to do this full time? Right? How long are you going to stay with the company? Is this something that you see yourself doing forever until we get to an exit? Or, no, this looks cool right now, but, I have something to contribute, but when I'm done contributing, I don't know what I'm going to do here. So, what about cash? How much money are you going to contribute? People want a share of the company. You know what a share of the company means? So when you say, I want 20% of the company, what does that mean? What did you just take on?
You're investing 20% of either your time.
20% of the expenses too, right? You want to hire somebody? Guess what? You're paying 20% of that, right? You need a lawyer, you're going to pay 20% of the bills. Owning equity without contributing, meaningless, right? Why would you want a partner that says, I want, but I don't want to give? Anybody want somebody like that? You know what happens when you're married to somebody like that? You don't get married for long, right? So it's the same thing in business. The way to really think about splitting equity and all the different things that we talked about is looking at the value, the contributions. I want to get to it, right? There are different ways of looking at it, the value multiplier and all that. This is what I want to see. What are you contributing to the company? What is your commitment to the company? how much time are you working in a company? You want 50% of the company? Are you there? Are you committed to 50% of everything in the company? Right? Are we, you want to be my equal partner? Are you going to be my equal in commitment, in time, and money, and effort, and everything else that it takes to build the company or not? So the way to do it, the right way to do it, I think, is to look at what the contribution is. What are you bringing to the table? And then we can figure out what your share of the company should be. So here, you can look at, right, time, cash, idea. Is it today? Is it in the future? Cash today is worth more than cash in the future, right? Are you putting in money up front or not? Once I had a situation where there was a student company and they won a big prize. And then after they won the prize, they decided to make it a real company. But the problem was there were 6 founders, but only 2 of them really wanted to stay in the company. But guess what they did when they started the competition?
They divided all.
They divided the equity into 6. And they gave all of these people equity, who guess what? Didn't want to be in the company anymore. But they had equity in the company. And they were like, what do we do? So what would you do? How would you solve the problem?
Buy out those people.
That's one way. You could. Why should you? There's a better way. What would be a way to do it?
You establish a new company.
So then
You establish a new company.
illegal. They'd sue you and they'd win. What would you do?
Negotiate with them in order to just
What?
negotiate when they just leave. Okay, then they give back shares.
Yeah, but I want to give them, and so they had 2/3 of the company,
Okay, maybe
and
just
us, we only had 1/3.
decrease.
Can you change the equity to, let's say, like common stock where they would potentially will have,
You get sued. So that's his idea. Same thing. You'll get sued. You'll lose.
Like reallocate, like the ideal level of contribution, not more, and reallocate the number of.
So I'll tell you what you do.
Okay.
And this is what I told them to do, and this is what they did, and it worked. So listen, go to them and say, look, now's the time, we won the competition, we got a small prize, but now we want to turn it into a real company. 2 of you are in med school, you're not going to really be working in the company. 2 of you are interested in the company, you're not going to be working with it. We want to keep working in the company. So basically what we said is, here's what we're going to do. Anybody who wants to stay in the company, great. You all have shares, you have to buy in. Everybody has to invest $5,000 in the company today. If you invest $5,000 in the company, you get to keep the shares. And if you don't invest, that's fine, you lose your shares.
Okay.
How does that work?
In other words, money talks.
Okay.
How did that not stop them from just saying, I want to keep the shares, but I don't want to pay?
No, I'm giving you the opportunity to be a contributing member of the company. But if you don't want that, then you're not going to have the shares.
Because none of them have made financial contributions.
3 of them agreed. And 3 of them said, it's too expensive for us. It's not what we want to do. It's not worth $5,000 to keep the shares. They were smart. The company failed after about 6 months, right? But the bottom line was the founders, the people who wanted to be serious, they had to find a way to keep the equity and not give it away to people who weren't going to be in the company. And that's the problem. That's why we have a year cliff, right? To make sure that the people you have, that you bring in, are going to stay and are worth it, right? And if not, we can separate ourselves from them without too much cost. Okay? So here is an example of, okay, I'm looking at, I create a value multiplier for different things. So cash today is worth 2 times, time today is worth double, cash is worth 4, et cetera, et cetera. I can create, this is what the contribution is worth from this person. So now I can compare it with somebody else. Here's my contribution, here's your contribution. And based on that, we can divide the equity if we want to divide it that way. Again, it's a way, it's a method, right? It doesn't mean it's the right way. It's a way. You could just say, listen, I'm keeping 80% of the company, or give you 20, right? Because I need to be in control, blah, blah, blah. Whatever it is, it doesn't matter. I mean, as long as somebody else is willing to do it. But the important thing is that if you take any co-founder, you have to make it clear. You're getting 20% of the company, you're responsible for 20% of the expenses too. You don't just get, you have to contribute. 20, whatever it is, whatever percentage it is, that means you're responsible for that part of the company. And if they're not, or if they don't want to be, that's not the right co-founder. The co-founder, the key word is commitment and contribution. They have to go together. As long as they go together, we're in good shape. When they don't go together, we're in trouble. Okay? Okay. That's it. So it's, well, can't be right. What time is it?
Yes. Correct. 2 o'clock.
Oh, it's 2 o'clock. So we still have 20 minutes. So let's do due diligence for a little bit. Let's go into due diligence. Step 2.
So I'm sorry, what about the private company?
One second. Okay, sorry.
Regarding my question, regarding my previous question, when you have the market valuation without any external investors and the company is growing like from scratch organically.
For founders agreement?
Oh, no, for the option stock.
Oh,
how to
option.
set the price for the option?
So what's going to happen is with options, there's an accounting problem, which I didn't get into because it's a little complicated. But there's something called fair market value.
Yes.
Right. So if let's say the price of the shares is $100, and I say I'm going to issue options for 10 cents.
Okay.
The IRS or the tax authorities, wherever you are, they'll jump down your throat because the exercise price is not related. It's not based on fair market value. So there's a problem. And the tax authorities require you to make the exercise price related to the share price. And so in the beginning, when my share price is $1 and I make an exercise price of 10 cents, nobody's going to fight with me. Or if my share price is $5 and I make a thing of 50 cents or $1, nobody's going to fight with me. But if I made it a penny at that point, maybe I'd have a problem. There has to be a connection, it's called fair market value. It has to be a connection to the actual share price. Okay? Okay. So let's talk about due diligence for a bit. I don't know what that is. Oh, I know what it is. Okay. So due diligence. So here's the scenario. When does due diligence begin? Who said it? Right from the start. The start of what?
The idea in the first place.
So again?
The idea in the first place.
Well, the moment the investor expresses interest to invest in the startup.
Okay, I'll pick that one. So from the very first minute that you meet an investor, or they meet you, or they see your pitch deck, from that very first minute, the due diligence process has begun. Is it deep due diligence? No. But it's part of. Due diligence so let's define due diligence. What is due diligence? There it is. So there's going to be two versions, two perspectives of it. From the investor, due diligence is everything I need to do, all of the investigation. By the way, somebody needs to tell me when it's 2:18.
Okay.
2:18, so we can get ready for the quiz. So what? 18. That means I have 2 minutes before the quiz begins and I can wrap up. Anyway, so one perspective is the investor's perspective. And the investor's perspective is due diligence is everything I can investigate to determine whether the investment lives up to my expectations of what I think it will be. In other words, I'm interested in this company, and I think it's going to be a great investment. Due diligence is what I do in order to make sure and validate that it actually will be a good investment, right? Whatever I need to do. Has anybody ever heard the expression, buyer beware?
Yes.
Who can tell me what it means?
What's it?
Buyer beware is like when you buy a used car, it's screwed up, that's on you. Like it was your fault that you didn't check if it was screwed up before buying.
Okay, that's an example. Well, what does it mean?
What does it mean?
Like, takes responsibility.
The
buyer takes responsibility.
You should be on like that show, they have to practice that.
Yeah, the buck. It means that the buyer has to do due diligence on their own without having any information given to them.
Okay, what are you going to do first? Very good, sir.
I would say it means that if anything goes wrong, the person who's paying is basically gets wrong.
Buyer beware means the following. It's the buyer's responsibility to make sure that what you're buying is what you want. It's not the seller's responsibility. If I'm selling you a used car, I am not obligated to tell you about the accidents that it was in, the repair work that I did. It's not my responsibility. It's yours. You have to uncover it. If I'm selling you a house, I don't have to tell you about the water leak or the problem with the boiler or anything else. It's your job, or the construction issues. It's your job to figure out whether it's what you want. If I'm an investor and I'm investing in a company, it's my responsibility to make sure that the company is what I think it is and not what I don't think it is. That's what due diligence is. And due diligence begins the moment I meet the company. Because from that moment on, I'm evaluating everything about the company I can at the stage that I'm at. Okay? From my perspective, from an entrepreneur's perspective, due diligence is what closes the deal. I'm not going to get any money until it's done. After the due diligence, if it's successful, that's when the investor will pay me, right? So it's the last stage before that. So the thorough investigation and analysis of the investor makes of a prospective investment to make sure it is what he wants to invest in. And there are many things that could get in the way of that, right? That would cause somebody to say, walk away. We'll see what's under them all, okay? So make better investment decisions. We've already seen this, I think, once, but we'll look at it again. When an investor starts, we said that the number of investments typically a VC makes is 1%, right? So here, one investment out of 100. But the way it works is that there's certain, as you go through the funnel, right, companies are falling away. So we said that an initial pitch deck, an initial pass to the pitch deck, how long does it take an investor to usually go through it? Who remembers?
The first deck, for the first deck, like 2-3 minutes.
How much?
2-3 minutes.
90 seconds. Why was it 90 seconds? Because I'm only looking for one or two things. I want to see that these one or two things are there. If they're there, great, we'll keep looking. If it's not there, I'm done. It's a binary decision. So for me, it's problem and market size. Not a big problem, not a big market, not interested. Right? We're done. That doesn't take long to figure out. But going through the rest of it, that takes time. And diligence is a process. Like I said before, it's a seduction, right? We start by trying to seduce the investor and get them more and more interested until we get to a term sheet. Once we get to a term sheet, now everything is laid bare. There's nothing left that's hidden. Everything is off. All the clothes are off, right? Everything's there. And now you get to check everything. So then I think you asked, you get to see the founders agreement, you get to see this, you get to see everything. There is nothing that you're not entitled to see at that point. Why? Because I have a term sheet. What's a term sheet? A term sheet means like I want to get engaged, right? Let's put it in relationship terminology. I want to get engaged. So, okay, it's time to check the goods, right? Some people might have checked the goods before that, but there we're talking about checking the goods. So, I want to get engaged. Now is the time. It's a letter of intent to get married. That gives me the right to sue. If I don't have a term sheet, I'm not going to give you everything. Why should I? Who knows what you're going to do with my private information? The fact that you want to get married, you want to make an investment in a company, great. Now I'm willing to share with you. But until then, you go drip by drip by drip, you know? Okay. So what we see is due diligence occurs in different stages, or it happens. Like there's the initial stage, which has the highest rejection rate, because I said it takes 90 seconds to decide yes or no. And as we saw here, right, 36%, this is like based on academic studies, I would say it's even higher, right? But 40% fall out within 90 seconds. There's no reason to keep looking, there's no reason to keep wasting time on it. I'm not going to invest. End of story. Right? It's the rest of it that takes the bulk of the time. And the guys down here, the bottom 5%, the last 5 companies that you're going to take a deep dive into after you have a term sheet out, that's going to take the longest period of time. Okay? This is the 80-20 rule in spades. Right? 20% takes 80% of the time. But it's even less than that. Less than 10% takes 90% of the time. Okay? Then once we get past the initial thing, right? Okay, it has or it doesn't have. Now there's like all kinds of other things that we start to look for. And now it's, forget about problem and market size. Now it's going to be, okay, what about the solution? What about the strategy? What about the competitive advantage? Okay, is this a company that we think has what it takes to do what? What is it that we want to find?
The curve. The curve is like multiplies.
Okay, now say it in English.
Yeah. Okay, so like really high potential growth.
Is this the company that's going to return the fund to me?
Yeah.
Is this the company that I'm going to get my return on investment from? Right? Because that's what I'm always looking for. So we're going to start to look at all kinds of things. What would be a big thing at this point that you might say, okay, that's it, I'm done?
Generally, people look at the team first.
Team first. What about the team?
Experience, qualifications, and the equation in the team.
But something more basic than that. I don't like you. No, I don't get along with you. I don't trust you. You could be the most experienced person in the world. I don't trust you. I don't want to spend my life with you. Right? That's much more basic. So one of the things that's happening is you're being evaluated as a person from the very first moment of interaction. And they're deciding, is this somebody I want to get married to? Figuratively. Is this somebody I want to spend the next 5 years with? Hunkering down, you know, in what do you call it? The trenches, right? Do I trust them? Can I work with them? So this is starts happening. The last one is going to be the fatal flaw. What would be a fatal flaw?
Bad personality,
So again,
a bad personality, the founder is having a bad personality.
okay, what else?
Lies.
The references,
What?
references, like from people who know this person, like,
Okay, what else?
the estimations or looking at some other slides don't match up with the information you're finding.
Okay, I don't know if that's a fatal flaw, but it's a big flaw. That would probably happen before that.
I mean, it shows that they're haven't done their research properly. That would be a pretty big strike.
But,
A clear indication of fraud.
somebody's a criminal. Fraud. Convicted felon. Right? A criminal record. You're gonna give millions of dollars to a convicted felon? You out of your mind? Right? That would be a big one. Right? What if the founders just hate each other? Like you talk to them, they work really great. They don't like one another. What do you think?
No.
That would be fatal. Yeah.
18.
What?
18.
Oh, 18, good. 2 minutes more. Great. Right. So I want to get to one more thing. Right. So, yeah. So basically the process is, we're going to finish this next week. Right. But the process is we start to get deeper and deeper and deeper and deeper into the company. Right. Now, the other thing I want to do is the problem with due diligence is that there's always a balance that you have to reach. And the balance, the question is, how much time do I have to do the work? Sometimes, in the old days, our average due diligence was 6 months. I mean, I remember doing due diligence for 6 months on a company that at the end, we decided not to invest in, right? But in 2021, due diligence was 6 days or 6 hours, right? Deals were getting done like that. A friend of mine told me she was really bummed out. I said, why? I ran into her one day. She says, I just did 2 weeks of due diligence on a company, and we wanted to make, that was it, 2 weeks. We wanted to make an investment, and another company just came in and made the investment before we could. I'm like, how do you do due diligence in 2 weeks? What do you mean? There's a balance. And sometimes the market dictates the time that you have. But you have to get to a position where you feel comfortable. It's buyer beware, right? So we'll continue this next time from here. In the meantime, I'm going to stop the recording, and you can open up your Moodles. The quiz is available to you at 1:20 or 2:20 or whatever time it is now. And when you're finished, you can just go if you want.